Now, joining us from our studios in Nairobi to give us an update on the Kenyan markets is Ken Minjire. He's the analyst at Stanbic Investments. Welcome to you, Ken. Could you kindly talk us through market activity today?
Thank you. The equity market, basically, we finally broke the resistance level of 3,400 by about 29 points. I think this was expected, seeing as on Thursday last week, we touched that level. Yesterday, we came off. So basically, if you are looking at your charts, I mean, the next most probable course was to break the resistance level of 3,400. I don't think we'll power through it too strongly as one would expect, because the market is still trading rather flat. But it's a good sign, actually, that even though we're trading mostly flat, we're having higher highs and lower lows.
Now, looking at that interbank, that average weighted interbank lending rate down by 11 percentage points to a low of 10.3% on Monday from levels of around 12.7% last week, really on the back of a government intervention there through repurchase agreements. Can we perhaps see this trend continuing?
I don't think it's likely. Looking at probably the commitments that we have in April, it being the end of, we've just come from the end of the first quarter. They are heavy, quite a bit, the tax obligations in April are quite heavy. These will probably hit in the third week of April. Also, the central bank has been quite active in the repo market, trying to mop up all the liquidity from government expenditure and maturities. Yesterday and today, in total, they've picked up about 14.6 billion. Also, we have an auction on Monday, actually tomorrow, with a value date of Monday. So, and this is looking to pick up about 7 billion from the market, although we have maturities of about 6 billion on Monday. So with all this going on in April, I don't think it's likely that the interbank rates will remain at these levels. They're likely to rise, not as steeply as we had before, to levels of about 20, but we expect them to probably trade at between 13 to 15%.
Looking at those rates, trading at 13 to 15% in the near future, like you say, there's lots of liquidity in the market. Where can we see the shilling trading for the rest of the week? I expect probably the shilling may lose marginally, where we saw that at the beginning of trading. Although technically you'd still say it's trading range bound, because it's still at about some quotes are still coming at below levels of 83, levels of about 82.95. But I expect it to continue losing marginally until the liquidity, CBK has the liquidity situation under control and the market begins to tighten. Now, looking at the CBK, it's to hold the Market Leaders Forum tomorrow to review last month's auctions. What are you expecting to come out of that meeting tomorrow? From
the meeting tomorrow, I think most of the market expects the government to issue a two-year paper. They're feeling fairly confident in the trajectory of the rates. This came out during last month's MLF meeting. So, and I think that was the last one-year bond they were going to issue. Also, if you look at the subscription levels we saw in the last one-year issue, they picked up about 15 billion, which was what they got from the market. It was about 100% subscription level. This is an indication that the market is actually starting to fill up on this issue, and the market seems a bit reluctant to go below levels of 16% on the one-year bond. So actually, I think the next course of action should be a two-year issue, and most of the market agrees. And in fact, if you look at trading that's on the secondary market, indications are that most people do expect a two-year, because we've seen quite a bit of demand overhang on the two-year tenor papers.
Looking at the equity market, we've had top three banks in Kenya, your Barclays Bank, Standard Chartered Bank and Citibank, really reducing their base lending rates by 5% from levels of about 24% in response to the central bank's CBR rate of 18%. What signal is this sending out?
Basically, okay, I think there are two different schools of thought on this. There are those who feel that probably CBK may be lagging behind yet again, as they did in early 2011, in easing the monetary policy and bringing down their CBR rate. But personally, I think probably it's more of a correction rather than a signal that the banks are moving ahead of CBK. Because what happened was once the CBR rate hit 18, we saw a knee-jerk reaction from the market, with most base lending rates shooting up, some as high as 28%. So I think this is, if you'd look at this as more of a correction, now they're a bit more sensible. They're realizing it's actually costly to them. The risk is a lot higher. Even though some of the loans have been rescheduled, the risk is quite high, and we might start to feel the effects on the NPLs. So basically, I think this is a correction downwards, because what's happened, most of them have priced their, the three banks have priced their CBR, their base lending rate around the CBR rate, about 19–18%, which is reasonable. And I think we should see a lot more banks take the same course of action.